Before we dive in, a quick note. You might notice that certain product names in this video have been edited or dubbed. This was done after recording at the request of one of the separate account managers we work with who asked us to remove references to their trademarked name. While the terminology has been adjusted, the strategy and insights we're discussing remain the same. Throughout this video, we'll refer more generally to tax-aware long-short, separately managed accounts, or SMAs. The magic isn't in trying to win on either side. It's working with the naturally occurring ups and downs of the market, creating consistent tax advantage losses across the long and short positions while keeping your investment exposure stable. Hi again. I'm Hilary Hendershott, CFP and founder of Hendershott Wealth Management. If you've made it this far in our series, walking through the tax-aware long-short strategy we use in our ultra-tax-efficient wealth management suite of services, which includes the use of leverage and short selling, you might be wondering, wait, doesn't this involve a lot of trading? Isn't that market timing? And haven't I heard 1,000 times from you, Hilary, that market timing almost always underperforms index funds? I am glad you asked. And it's true. Active trading has a bad reputation. And for the most part, it deserves that bad reputation. But the active trading that happens within the tax-aware long-short strategy is not about chasing headlines, jumping in and out of the market, or making bets based on guesses or gut feelings. It's a systematic, rules-based strategy to produce a small amount of excess return and make the tax code work in your favor without altering your long-term investment plan. So welcome to video 6 in this series where I'll break down what active really means in this context, and I'll walk you through how the tax-aware long-short strategy works from the ground up so you can understand why we consider it the most powerful tool in our ultra tax efficient wealth management suite in many cases. There's a key distinction between traditional active trading and how it's used in tax-aware long-short investing. And it has to do with the intended result the investment manager wants to produce. Traditionally, active trading is about chasing large potential returns by trying to time the market, predicting what will go up or down next and when. It's reactionary. It can be very emotional, and it can lead to buying high and selling low. In contrast, the long-short overlay used in tax-aware long-short is systematic. It's a disciplined, evidence-based overlay that follows a set of consistent, rules-based algorithms that have been built on decades of academic research. And while, yes, it involves regular trading, the strategy is not solely focused on beating the market. It's engineering portfolios to do a few things. It creates more opportunities to harvest losses to lower your tax bill. It does not sacrifice liquidity or add market risk. And it leaves your core investment strategy and the returns it produces fully intact. So while active trades are happening, the intention is not to outguess the market. The intention is to optimize when and how much taxes you pay, following the IRS's own rules. There's no predictions, only the strategic production of tax alpha, higher net returns that don't come from investment performance, but from smart tax strategy. Here's what's going on behind the scenes. Inside the tax-aware long-short strategy, there are 3 components to the foundational approach. 1, the core portfolio. This is your globally diversified long-only portfolio. It's low-cost, passive, and built for growth. We use this as collateral, not to gamble, but to unlock opportunity. 2, the long overlay. We borrow at a low cost and invest in more diversified positions. That boosts the size and number of positions in your portfolio, creating more opportunities for both returns and harvestable losses. But borrowing creates downside risk, which is inoculated against by the third piece, the short overlay. This is the safety mechanism. We sell stocks we don't own by borrowing them from the custodian and selling them. and eventually repurchasing them later to return to the original owner. If markets fall, these short positions make money, which offsets the extra losses from the expanded long overlay. Together, the long and short overlays create tax losses, whether the market is up or down, without generating portfolio losses because one is always doing well and the other is not. This is your tax alpha. The magic isn't in trying to win on either side. It's working with the naturally occurring ups and downs of the market, creating consistent tax advantage losses across the long and short positions while keeping your investment exposure stable. Again, it's not guessing. It's strategic management, where the system identifies hundreds of long and short positions. Trades are executed regularly based on rules, not opinions or speculation. It's fully diversified, so no single position can sink the strategy. And it's market neutral, meaning your total risk exposure stays the same. Even when markets are up, the strategy finds opportunities to realize losses in the short overlay, which offset taxable gains in your core portfolio. When markets are down, we are harvesting losses from that long overlay. That's what makes this so effective in achieving tax alpha. You keep your market returns and sometimes even net higher ones, but reduce your tax burden. And you don't need to be a tax strategist or portfolio engineer to benefit from this strategy. That's what we're here for. Our team and the separate account managers handle it all on your behalf. And the result? You stay invested and you keep growing your wealth, but you dramatically reduce how much of it goes to the IRS. Let me be crystal clear. This isn't something we stumbled into. As fiduciaries, we're legally and ethically obligated to act in your best interest, and we always do our due diligence. In this case, we did months of it. Before adding the tax-aware long-short strategy to our ultra-tax efficient wealth management suite, my team and I went heads down in due diligence mode, including we did a thorough vetting of the custodian, Fidelity, and probably Charles Schwab in the near-term future, and the investment manager. We evaluated the strategy's track record. We independently confirmed the strategy's efficacy. We quantified the strategy's risk. We verified account holders' access to their capital. And most importantly, we affirmed that it will help real people like you reduce their tax bill without sacrificing performance or increasing risk. Our conclusion? This strategy isn't for everyone, but for suitable clients, those with $1.25 million or more in taxable assets, tax-aware long-short investing makes a meaningful, measurable difference over time, potentially increasing your lifetime wealth by 30 to 50%. And it's aligned with the same evidence-based long-term approach we've always believed in. So is this active trading? Technically, yes. But in spirit, no, because it's not about market timing. It's thoughtful, engineered tax efficacy. It's staying invested while minimizing what you owe Uncle Sam. And in many cases I see, it's one of the most powerful upgrades we've ever offered our clients. If you're wondering whether the tax-aware long-short would benefit you, we can help run those numbers. Head to hendershottwealth.com/contact and schedule a complimentary 45-minute Discover call with one of our lead advisors. We'll get to know your financial picture, understand your goals, and help you determine whether this is the right next step for your wealth strategy. And if it's not, we'll point you towards something that is. See you in the final video. There, we'll bring everything together and show how these pieces work in one seamless, tax-efficient strategy.